of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Okay, looking good. Billy Ray, feeling good, Louis. We have our guest today is Bill Meridian out of Vienna, Austria. Bill, how are you doing today?
I'm fine, Larry. Can you see my screen?
Yes, sir. We're all set up. It sounds like you're right next door. How's the weather over there? Cold, warm?
It is
story?
50 degrees Fahrenheit.
Oh, my goodness. What happened to the cold freeze that was supposed to come through?
Well, we have it up in north in the Tyrol where actually 10 people got buried in an avalanche, but they managed to find them all.
And they were alive?
Yeah.
Wow, unbelievable. Bill, that's enough of that. Tell us what you're looking at, my friend. You always have some great stuff, especially when you've been spot on in gold bonds and also the stock market. So tell us what you're looking at here, my friend.
Well, first, that's winter in Vienna. That's Stephansplatz or St. Stephen's Plaza. That's what it looks like in winter. Mm-hmm. So, and now I'll tell you a big Wall Street secret that I've been aware of for years. When you listen to guys do presentations or pitches on funds, which fortunately I only had to do for 3 years, a buy and hold is green. If you bought and held the Dow, that's the green line. And they always come in and tell you, we're 100% invested. Now, the reason they're 100% invested is they have no idea how to predict the market. So they say if you miss the 10 best days, that's the blue line. You see how much you would have lost. But they don't tell you, they never mention the red line. If you miss the worst 10 days in the year, that's your performance, the red line. So in other words, if you miss the worst days in 22, 21, 20, that's because, and we know the reason for that. Does the market go up faster than it goes down? No. The price appreciation and confidence builds. It goes up a little bit each day. And then when it gets, as we say, overbought or you get a sell signal, bang, it comes down very quickly. So down moves are bigger in magnitude than up moves. And in his book, the Encyclopedia of Technical Analysis, my old friend Robert Colby pointed out that if you could have gone back, now this is about 10 years ago, the book came out, but from 1915 up until about 10 years ago, if you could have shorted the market on September 5th, that's the Dow Jones, and covered it on October 27th, you outperform a buy and hold by 3,000%. Wow. So in other words, that's how much that, and let me just throw in some old observations from my friend Ian Notley, who hired at one point a quantitative guy. And he said if you buy any stock in an uptrend versus a downtrend, like in a bull market, if you buy any stock, what are your odds of making money? Not outperforming, but a positive return, making money. And he said, well, his answer was it's 3 or 4 to 1. But if you buy any stock in a bear market, the odds are 20 to 1 against you. That's buying in a bull market, 67 to 75% of probability of success. In a bear market, 5% chance of success. Wow. So unless you're a super expert, buying into a downtrend is not wise. Like all year, technology's been down. If you bought into technology, there was a 5% chance you'd make money. But if you bought into energy, there was a 67 to 75% chance that you would make money. This is one of the great secrets they don't want you to know, because the funds don't know how to predict. They don't want to pay me anything to help them predict, and they just don't try and predict. So what they do is they show you this graph, but they white out the red line. So they only show you the buy and hold and missing the 10 best days. They never tell you anything about missing the 10 worst days. So
that's very good information, Bill.
no longer a big secret. So this year, 2022, there's an 80% likelihood of higher prices this week. Now, that hasn't worked out too well. I'm going to show you why coming up, but that's a key to next year. The S&P is likely to rally into the first week of January and then decline. I haven't changed this all year. Bear market is to resume in 2023. I'll show you why. 1, 4, and 10-year cycle and the dynamic cycle both drop this year for a substantial portion of the year. Inverted yield curves bring recessions and lower markets. And commodities, gold and oil, are likely to move higher and bonds lower. That's my conclusion. So this I'll cover very quickly because we looked at it last time. This is the Ed Dewey's indicator, the founder of the Foundation for the Study of Cycles. In '69, he wrote Stock Prices, Mercury in Space. He studied the conjunctions of Mercury and the Sun, which are times when they're 0 degrees apart. And he looked at them when they are in Capricorn, which he called the 10th sector. That can only occur December 20 through January 19. This one is falling on the 7th, and there is, let's see, first of all, December has risen in 68.5% of all cases from 1885. But this graph, that where I have the vertical line, that is the exact occurrence of the conjunction, which is in the first week of Capricorn. It's next week, the first week of January. That's next week. And now, from 23 days prior to the conjunction to the day of the conjunction, the S&P has risen 84% of all cases. At the moment, it's going to have to rally very strongly to make that work. So the reason I'm bringing it up is I brought this up in London when one of these delightful old gentlemen, like from an old Basil Rathbone movie or from an old Sherlock Holmes movie, British gent says to me, well, why did this cycle not work over here? And I said, there are much larger cycles that might be thousands of years long or hundreds of years long, and we don't have enough data to monitor those. So if this effect, which has been so strong, up 84% of the time on the 23 days before the conjunction, this means the bullish effect started on the 15th, but the 15th started with a decline. And at the moment, I think I just calculated the S&P would have to rise about 80 points, which I don't think it's going to do. So if this is going to fail, this means there's something else bigger pressing down. It's like holding a balloon underwater. So let's take a look at the 1, 4, and 10-year cycle, the dynamic cycles, the number cycles I'll describe, and the planetary cycles, of which the annual cycle is one. Well, the 1-year cycle is just that. The market rallies in the spring. It usually tops in the summer. June and September have been very weak. There is a great deal of volatility in October, but October usually rises and brings lows. November, especially December, are usually up. That's the 1-year cycle. I went to MIT. They asked me to speak. I said, what am I going to say to these people who were doubting Thomas's? And I said, how many people here believe in the seasonal cycle, as I just explained? And about 75, 80, 90% raised their hands. And we'll pick it up after the commercial.
Yes, we do. Pay a few bills for TFNN. We'll be right back with Bill Meridian, Cycles Research, Vienna, Austria.
Currencies, commodities, and bond markets are as important as ever right now with how they're driving the volatility in equity markets across the globe, which is why it's a great time to try out Teddy Kakestat's Tiger Forex Report. Teddy Kakestat breaks down the Forex markets every Monday using his 30-plus years of experience as a trading veteran of futures, Forex, stocks, and options. Teddy releases his weekly Tiger Forex Report every Monday morning with coverage of all the major currency pairs, including the dollar index, the euro dollar, pound dollar, dollar Swiss, dollar yen, as well as many more, and he also has weekly coverage of the crude oil market and the 30-year T-bonds, as they both influence Forex markets tremendously. When you sign up for the Tiger Forex Report, you also gain instant access to Teddy's 60-minute webinar archive he just hosted, Forex Strategies and Fundamentals, What is Behind the Tiger Forex Report. For all the details and to start your 30-day Tiger Forex Report subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
Are you looking for a way to consistently add winning trades to your portfolio? Tom O'Brien is here to help. Tom O'Brien has been successfully trading markets for over 30 years. A frequent contributor to TD Ameritrade Network and CNBC, Tom O'Brien founded TFNN over 20 years ago to help educate investors just like you. Tom's daily market newsletter, Market Insights, is published every morning when the markets open to give you the competitive informational edge you need to succeed. These newsletters are packed full of Tom's advanced technical analysis and are geared to deliver comprehensive strategies for a successful portfolio. Get Tom O'Brien's newsletter, Market Insights, today and try all of our products and newsletters 30 days risk-free with our money-back guarantee at TFNN.com. TFNN. Educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, folks, we're back. We're speaking with Bill Meridian, Cycles Research, Vienna, Austria. Bill, I have a question about that Mercury cycle, Mercury conjunction, because I looked at that very, very closely when I was writing that book, Astral Cycles, The Trader's Viewpoint, and there was a man named T.J. Butani, I think, and he called that thing combust, where Mercury came at like 0 degrees, and God, it was so powerful at calling highs and lows in the market during those years that I was doing it. It was just really amazing. And does that have any type of similarities to full moons and new moons? That's a question that I have.
No, not that I know of.
Okay, that's all I wanted to know, because if they come together, I would think there would be some type of a additive, but that probably doesn't happen very often. Please continue. I don't want to stop you. I love this stuff, so please go. Well,
we left off at the 4-year cycle is called the election year cycle, but my old friend Ian Notley pointed out that, the theory is the Federal Reserve Bank juices up the economy right before the election. So the year before the election, which is where we're going, is the most bullish. The year of the election is the second most bullish, and 2 years after the election is the worst, and then the following year is somewhere in the third place. And Ian said that was a nice theory, but he pointed out that the 4-year cycle existed before the establishment of the Federal Reserve in 1913. It also exists in countries where there was a 4-year election cycle, a 6-year election cycle, or no elections whatsoever. So there's simply a 4-year cycle. The 10-year cycle was developed at Ameritrade Bank back in the 30s, and that is years ending at 5 usually have the best returns, years ending at 0 have the worst returns. So that's one. I put those all together into one cycle set. Number 2 are dynamic cycles, which use sine wave analysis, spectral analysis, to look at the latest numbers. And my software does that, but what mine does is it immediately computes how much money you make, and to put it in plain English, rather than I'm not looking for the Nobel Prize in quantitative finance. So that's a second set of cycles. And let me just let me finish and I'll go back. Number cycles. Gann used to say, look at the market 10 years ago, 20 years ago, especially 60 years ago, and you can include 72, 144. And if they happen to all agree, let's say they all agree that next month is going to be an up month, then that's an added plus for the bulls. Planetary cycles. Now, I'll go back to the one-year cycle. They invited me to speak at MIT, and I thought, what am I going to say to these guys? And so I started out with saying, how many people believe there's a one-year cycle, that the market rallies in the spring and so forth? September's very weak. And almost everybody raised their hands. I said, well, how do you get the dates? And, of course, somebody finally said a calendar. I said, how is a calendar derived? It's a question nobody wanted to answer. It's the relative position of the Earth and the Sun. So the annual cycle is a planetary cycle by definition, number one. So a lot of people say they don't use planetary cycles, but they use that, not seeing the connection. And the second thing to know is that is the orbits are elliptical. So it is not a round cycle, it's an ellipse. And dynamic cycles, number two here, assume all cycles are circular, which they're not. So that's a deficiency of dynamic cycles. So I use the other cycles to try and make up for that or offset that. So it's best when they all confirm. That's what I'm looking for. If you get half of them pointing up and half pointing down, you can pretty much presume it'll be a trading range. So 1, 4, and 10-year cycle, this is last year. On the top, the blue line is the summary of the bottom three. The blue line on the bottom is the decennial or 10-year cycle. The red one is the simple annual cycle, and you can see it always declines. You see the decline in September and the low in October. The average high in any year has been September 5, according to Colby's encyclopedia, and the average low is October 27. And then in green, you see the election year cycle. So this worked pretty well last year because you had a low out here, you had a low out here, I think, in the second week of June, and this projected the third or fourth week of June. And then you had this decline, which should have started in the fourth week of August, but started in the second week of August. And then you had the bottom here was actually around October 11th, I think. So it was a bit early calling that by about 2 weeks, and it should show a strong December, which it has not yet. So that's 2022. Let's move forward. That's this is the fourth quarter. That's just that blue line blown up to show you the fourth quarter. And the low was back around here, I do believe. So this is the 1, 4, 10-year cycle in 2023, except the blue composite line wound up on the bottom instead of the top. The red cycle is the 1-year cycle. Again, you see the big weakness in September. You always see that. And then the 4-year cycle is the election year cycle, which peaks here in July and bottoms in September. And then you have the 10-year cycle, the green one, which peaks up here in June. If you put them all together, they hit a high point in April. They hit a high point in April. May and June are down. Then you get a July, not much of a rally. Then you sell off again, get not much of a rally, and then down. But again, in Q4 this time, not much of a rally. So we can conclude from this that the high will be around sometime in April. Let's go to the dynamic cycle. And I just ran this 2 days ago. And where's the high? April. So does that confirm that? Yes. So at the moment, I'm saying that there is going to be probably a rally and a not very good one up into April. But look at the rest of the year. Look at the rest of the year here, which is the blue line on the bottom. And look at the rest of the year here, this gray line. So no, it doesn't look like a very good year. And I want to add in one other thing. This is important right here. You see this high here in very late December and a low. Just keep that in mind. That's around January 18th to 20th. Now, the reason I'm bringing that up is because the action from November to January is very important. And a quantitative analyst discovered this, shared it with me, and I said, do you know why that is, my friend? That is because the big institutions, we used to start talking about what the market will do around Thanksgiving time, and we would have set all the positions maybe by the second week in January. Now, after a big institution does that, they're not going to trade out of them 3 or 4 months later, even 6 months later. You'd really have to have some very good reason to get out of it. They're going to hold them. So I said the reason that your indicator works, November to January, if that's up, there's a very high likelihood that the market will be up for the year. Now, it doesn't work before 1950. I went and tested it myself because the institutions didn't have the purchasing power to control the markets that way. So The key date is in about the third week of January, and according to this, the market's not doing well right now. And so if you go back and look at November, and if we're going to be lower by the third week in January, we are going to get a sell signal for the second year in a row on that indicator. So now we've got 1, 4, and 10-year cycle topping in April, this cycle dynamic topping in April, and that November to January setup where the institutions set their positions looks weak. So at the moment, we're batting 1,000 on that. And here I'll apply contrary to opinion. This is the last Barron's, and it says right over here, stocks could pop 10% in the new year. We'll apply contrary opinion.
Wow. Bill, this is such...
Yeah.
I really hope the folks enjoy it as much as I do. Please stay with us. We'll have Bill Meridian back. 877-927-6648 for your call.
If you want to take advantage of this sector, now is the time to subscribe to my Gold Report. The Gold Report is a comprehensive look at the metal sector as well as the markets that move gold, which is the currency and bond markets. New subscribers get a 30-day money-back guarantee, so you have nothing to lose. Every Monday morning, I publish the Gold Report with coverage of gold, silver, bonds, the XAU, HUI, JDX, as well as more than 30 different mining equities. To see for yourself the types of profitable trades that are recommended within the Gold Report, sign up now by visiting TFNN.com. Don't miss out on the next great gold trade. Sign up today.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Okay, we're back, folks, speaking with Bill Meridian, Cycles Research out of Austria. And Bill, would you please continue? And Bill, I've had you on here as a guest for a long time, and from my perspective, that first half hour was the best half hour I've ever seen. And you've had some really good ones, so please continue. It was really good. I really enjoyed it.
Well, thanks. I hope it works out that way. We'll be back 1 year from now.
Yeah,
anyway,
we'll find
there's
out.
the cover of Barron's Contrary Opinion Sell Signal. Stocks could pop 10% in the new year, so we'll see. Now, short term, I don't think the S&P is going to break through this downtrend line, which is running here at around, sorry, I hit this a little too hard, which is around 41, well, it's around 4050, 4050. I don't think we're going to get above it. And I'm looking at things like new lows over new high. New lows are expanding over new highs every day. So that is a negative technical. Now, where do I think the market is going if it's going down? Well, first of all, you see all these Fibonacci retracements here. You see one from the 87 low. Now, look at that crash that rattled us. Look at how tiny it is now.
I know.
And we start there, and we run this up to the high, and then we start another one over here at the 2008 low up to the high, and another one over here. And we look for what Joe DiNapoli would call confluence. We look for areas of support. Now, the one I see down here is 3,200, 3,300. That's 61.8% of the shorter time period, and that is 38.2%, which is measuring from the 08 low up to the 2022 high. And in the words of Tony Plummer over in England, a 38.2% retracement is normal. If it breaks through that, that means the perceptions of the fundamentals have changed, which means you might get much lower prices. So my target on the downside is 3,200, 3,300, but it's probably not coming until later next year. And well, this is just January, how I start looking at a market. All Januaries are up 59.3% of the time from 1885. But in an election year plus 3, which we'll be going into, it's 71%. The decennial pattern is 46.1%. If you put them all together, it's 68%. Just to get an idea of what. So the election year is the one that is inflating that number. Now, what stocks should you buy or sell? And this process has been applied to the Dow Jones 30 stocks. Over the last 33 months, the long stocks have risen by an amount about 60% greater than that of the short sales and 28% over the Dow Jones. The short sales were net negative over that time period, which is almost 3 years. It's minus 16%. So the software now can run, I can run this back, and on the S&P 500, from the first of the year, the longs are up 30%, the shorts down 36%, and the S&P is off 20%. So it works for the Dow. I did that by hand for 3 years, and we had a screen set up. The left column here is the seasonal rank, and the second column is the relative strength valuation rank, which is relative strength, but it's a very special mix or formula that was developed by quants who optimized it. So the seasonal rank just means that BKR, Baker Hughes, is number 8 if you look at all the S&P 500 stocks as to how they perform in January. Schlumberger is number 3. And Devon Energy is 6, and you're saying those are all energy stocks, aren't they? Yes. In other words, January is traditionally strong. So that's the seasonal setup. This is the relative strength. So at the moment, I think this holographics is number 3, and Host Hotels, don't ask me why, is number 5. So the lowest rank, which is the most bullish, is holographics, then Baker Hughes, Hewlett-Packard, Southwest Airlines. I forget what these guys do. That's Marathon Energy, Nucor Steel, and that's Host, as I mentioned, Schlumberger. That is Peak. I think it's Peak Energy. I don't remember what that is. ALK is Alaska Airlines. Qualcomm, Devon Energy down here, and that's GLW is Corning Glass. And Allstate Insurance. Then we have Raytheon, Micron, Exxon, and on down. So this is a list that's based on something that's happening now, the relative strength, and something that's going to happen next month, which isn't too far away. And this is the bottom of the list. The worst relative strength is this out of 400, out of 500 stocks. Progressive Insurance is 485. Roper is 489. This is, I forget the name of the stock, but ROL is Rollins, SYY is Cisco, but it's the food Cisco, not the router Cisco. So the seasonal rank, in other words, of the entire S&P 500, this stock, PGR, is 268th in the middle of the rank. So there's no seasonal strength, and it's got very weak relative strength. So this is a list of potential shorts. And the tests are done. I just take the top 5, go short. The bottom, the top 5 and go long, the bottom 5 and go short. That's how the numbers have been generated that I gave you, the performance numbers. So that's what I think of. That's where I'm going to start looking to short stocks in January. Now, this is from the December 1st show, Larry. This is the U.S. 10-year note in the state of January, in the month of December. And the red line is the likelihood that it will go up. So, for example, on the 3rd of January, there is a 70% likelihood that this 10-year note will appreciate in price. The blue is the percentage gain, which is about 20 basis points, and the green is the product of the first two. In other words, there's a 70% chance of making 20 basis points, which comes out to around 14 basis points. And you will note there's the floor falls out, the bottom gives way for some reason. You see the arrows here from the 18th to the 22nd. Would you believe that price index has been down 82% of the time? I just closed out a profitable short position on this on Friday.
I remember that very well because you pointed it out, and boy, it's been spot on. We thank you for that one, my friend.
Yeah, so that this will occur again in the 3rd week of June, the 3rd week of March, and the 3rd week of September, and I don't know why. You can ask the Grand High Muckety Muck at the pearly gates, and he probably doesn't know either. So this is the notes in 2023, and you'll note another stocks topping in April. This is May. I'm a little less confident in this one because I remember, Larry, you and I lived through the 70s when interest rates went to 15%, which all of Wall Street predicted that, didn't they, Larry?
Yeah.
Nobody predicted it, except James Dines, maybe.
Yeah.
And so you'll see that notes are going down into here. So actually, I closed out my short position, and I might reestablish it because, look, the first half, the month of January looks bearish. Then you're going to rally up into May, then down the rest of the year. I believe that because there's so much debt outstanding that I don't see how rates could not go up. Mm-hmm. So this is the U.S. notes monthly histogram. And again, the red is the probability it's going to go up, which is about almost 70% next month. That's one of the reasons I haven't shorted it. This doesn't agree with this. The two are giving conflicting signals. But look at March. Look at March and look at June, look at September, and look at December. All of that weakness occurs in the 3rd weeks of those months.
Wow. We got it. Harry Schultz was another guy that was talking about high interest rates. That's the only guy I can remember. Hey, we'll be right back with Bill Meridian Cycles Research, folks. Stay tuned, please. 877-927-6648.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Okay, we're back, folks, and we're talking with Bill Meridian, Cycles Research. Bill, did you ever meet Harry Schultz?
No.
I met him in Hong Kong many years ago. Of course, he was a rampant bull in gold and silver and stuff. But without doubt, Bill, he was the most arrogant person I've ever met in my 60 years in this business. God, you talk about self-confidence. Oh, my God, his parents injected something in him at birth. Anyway, let's move on, Bill. What else are you looking at, my friend? These spots in bonds last year that you gave us were just absolutely, stocks too, but the bonds were just absolutely amazing. So please continue.
Well, I'm glad I didn't meet Sir Harry. Anyway, there are notes, and that's the U.S. notes monthly histogram. So the key is, you notice the month of March. Well, I think I went over this one, didn't I, just as we broke? So we'll move on. Now, what is the market discounting as a recession beginning? Well, look at this. This is the new orders from the Philadelphia Fed, and look where it is. It's down where it was in the 70s and 80s. New orders down. It's in negative territory. Historically, one of its third lowest levels since about 1970. And then here's an inverted yield curve. If short-term rates go above long-term rates, that means there's a scramble for credit just to stay afloat. And an inverted yield curve has always been followed by a lower market and a recession. And then bear markets do not end before recessions begin. Well, we had 2 consecutive negative quarters of GDP growth. And I don't know if you remember, when I was on years ago, Scotland and the United States, I think it was 3 years ago, they started talking about, well, using GDP to measure economic growth, it may not be the appropriate measure. I said, they know that the policies they'll institute are going to bring the economy and the markets down, so they want to change definitions. So the recession, the current administration is saying it hasn't begun, but the traditional measure is 2 consecutive quarters of negative GDP growth, which we've already had. So let's go over to gold. Now, we're in December. And December, this week in December, looks the reverse of the gold. I don't know if I have that in here, but it's a very strong Christmas month. And look at January. Again, the red up about 55% of the time for a 175 basis point gain. If you multiply that times that, you get the green line, and you'll note the expected return is the highest for the year. So should you be selling gold right here? No, you absolutely don't want to short it. So that is the gold. Now, that's the static cycle. It doesn't change. Let's look at the dynamic cycle, which does. Look at this. It up in January, then a low in March, and up for the rest of the year. So I think the gold bulls will be very happy this year. I think they're going to there's a degree of fulfillment here after waiting so long. And this is gold weekly. And I had said it would go up to here about 1850 before it backs off. And that we may have a little weakness as January opens up. but then I think it's going to go higher for the rest of the year. Here is oil. Nothing ever saves oil from this period, October, November. It's always down very sharply. We're coming up out of that area, and we're going into the January up through April, May, this first 4 to 5 months of the year. So we're in a bullish phase for oil, looking at the static seasonal cycle, and we already looked at that. You know what that was? My picture of Jackson Square, New Orleans, just fell off the wall for some reason. Anyway,
wow.
Sorry for the crash. But you'll note the dollar
is very minor.
You'll notice the dollar is going from its weakest month, December, to its strongest month, January. So if you are long euro or short the dollar, I would close that out this week, because January has been up almost 60. Well, that's about 58% of the time for a very good. It's the strongest month of the year, following the weakest month of the year. And the U.S. dollar, we have long-term data on the dollar from the Foundation for the Study of Cycles. And we notice this breakout here, and then, this goes back to 1880 or so. And it formed, it looks small on the graph, but that took several years, and it's broken out to the upside. And any technician will tell you that's bullish. So that's one of the reasons. So what is the fundamental reason? Well, when the rest of the world gets in trouble, everybody puts their money in U.S. dollars. I've lived overseas for 32 years, so I've seen that happen. And Larry, last time I said we were in the wrong business. We should be in baseball cards. Well, I can add wine to that. The blue line is the Wine Investables Index. And you can see it's well ahead of the S&P, as are the baseball cards.
Wow.
So no portfolio complete without wine and baseball cards.
That wouldn't include wine in the box, does it? Or that's a different index?
I don't know about that. And, I've shown the 18-year
Italian.
real estate.
You know what that is.
Yeah. The 18-year real estate cycle has topped, and here's the evidence. Withdrawals from non-traded real estate investment trusts. You can see that green bar on the histogram. It's at the highest level in 4 or 5 years. Here's the real estate cycle. This is Halifax Standard average house price. And note the very sharp drop in the month of November. And Phoenix and Las Vegas are on track to become the first big metros with year-over-year rent drops. Now, if you ever told me rents were going to drop, but this is all, the cycle does not top until 2023, which is only days away. But, I've shown it to you every time I'm on. I left it off this time because I figured everybody's seen it already. Number 4. This is from the Fed, the average sales price of houses sold for the United States divided by the federal minimum hourly wage. In other words, how affordable is housing? A high level suggests it's not very affordable. And back here, when I bought my place in New Jersey, which has now risen 4 times in value, it was 2012. I got it about on the low tick here, I think. So this is just more and more evidence coming in. So let me go back to the beginning. I don't think the market has discounted the negatives. This is one of them. I don't think people realize that real estate, I think, is going to take a sharp drop here. It's already started a year early, and most consumers consider the inflated value of their house to be a piggy bank, like a credit card. When that disappears, that'll cut retail spending. And on the other hand, what's one of the other negatives? Before we got on here, I'm reading Paying Americans Not to Work by Professors Mulligan and Antoni. A family of 4 can receive over $100,000 annualized equivalent in cash and benefits in 3 states and over $80,000 in 14 states with no one working. Wow. What kind of a sustainable model is that? Again, it's called Paying Americans Not to Work. Punch that in, and you can get the 16-page PDF. It's very simple to understand. They compare that to what people who really work earn, and it's really startling. So, well, I'm on Forbes in the Great Speculations area and the Foundation for the Study of Cycles. We're back at cycles.org. I'm on the board. And if you're interested in Bill Meridian things, you can go to billmeridian.com.
Wow, Bill, this is really good stuff. Of course, we've been friends for a long time, and I'm certainly a big follower of your work, but this was somewhat the best I've ever seen. Listen, a happy holidays to you, a wonderful new year, and we'll have you on the year of 2023, believe it or not. Unbelievable. 877-927-6648. Stay tuned for the update, folks.
If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Okay, folks, we want to thank Bill Meridian for his wonderful explanation of what he thinks is going to happen, and pay attention because we have him on all the time, and he's certainly been accurate, and he's predicting some pretty serious moves to the downside in real estate, stocks, bonds for 2023 and beyond. So that's a very interesting thing. Now, what I'm going to do now is I'm going to post the chart that I put in the newsletter each week. Of course, when John Jameson helps me write it, and you'll see, it didn't work. Just a second. Something happened here. Not good. Let me see what happened. Hold on just a second here. Maybe it's not going to work. Yeah, this should work. Let's get it up here and see if we can get it here right now. No, something's wrong. I don't know why that chart is not posting into Tiger. Okay, it's good now. Anyway, but our downside target for this cycle is at 3150, I believe is what we're looking for. So pay attention to that. It's very, very important. But the main thing, folks, is the bond market, and that's many, many times bigger than the stock market. It's predicting that we're going to be seeing higher interest rates, much, much higher interest rates. I was involved in the markets, way back in the 60s and 70s, and in 76, when I went to work for Drexel, rates were about 8%. They went up to about 13% in 1980 when Paul Volcker took over and then slammed the door on it, and then they went down ever since. That's 30-some years. Markets, the bond market has been going up. It topped 2.5 years ago when they were trying to tell us about negative interest rates, and now we're going to be looking at higher interest rates and maybe even a liquidity crisis. So it's important that we pay attention to what these markets are doing, especially those. So live every day in an attitude of gratitude, and may God bless, and thank you for listening.